Hello everyone and welcome back to the sessions on fixed income for CFA Level 1. In this class we are going to talk about sovereign debt issuance via public auction. The manner in which a corporate entity issues fixed income securities and the manner in which a sovereign government issues fixed income securities. These are different. Sovereign debt issuance happen via public auctions. So what happens? The objective is to have transparency in terms of the pricing of the bonds. So let the market decide, let the investors decide what price they would want to offer. So they don't specify, means the issuer, or I would say sovereign debt issuer does not specify the issue price. It is allowing the investors or the subscribers of the instrument to place their bid, in an auction process. So that way it will be a complete liberty, complete transparency, complete option given in the hands of the investors to place the price at which they want to buy these bonds. So they place their bids. So this is a very interesting process indeed, and this process will comprising of two different categories of investors: those who place competitive bids, those who place non-competitive bids. So what is a competitive bid in this issuance process? What is the non-competitive bid? It's very interesting to understand, and let us discuss the whole process. So let me first give you some important notes over here, and while I provide to you these notes, I will request you that you can pause the video wherever you want and take note of these important notes. I will not be allowing you any additional time to note it down. So under the heading sovereign debt issuance via public auctions, you may write sovereign debt issuers, that is the government issuers or treasury issuers typically issue government debt securities through regular public auctions. The purpose is to raise funds in an organized, transparent manner where market demand helps determine the price and therefore the yield of the new issue. Types of bids in a government auction. I have already mentioned to you there will be two categories of bidding, that is one classified as competitive bids and another classified as non-competitive bids. So let us first understand these two categories of bids, that is competitive bids and non-competitive bids. An investor who is interested in investing in government securities or sovereign debt will be classified into any of these two categories. It could be a competitive bidder or a non-competitive bidder. But what are these bids? So let's first understand what happens in case of competitive bid. So let's say an investor who is placing a competitive bid, say a $1,000 par value bond. The investor is ready to buy the bond only if the bond is offered at $990. So first of all, the investor has placed the bid that the investor is willing to pay, that is $990, and the investor is ready to buy the bond either at $990 or still a lower price. The investor is unwilling to pay anything beyond $990 for that bond. In other words, if I am a competitive bidder, then I'll place a competitive bid, and it indirectly indicates that it is going to be either my price or a lower price, definitely not a higher price. That is the case of competitive bid. What happens in case of non-competitive bid? Non-competitive bidder will simply say that, see, I want to buy 500 such bonds. At whatever price you offer me, I'm okay with that. I just want to buy these bonds. So a non-competitive bidder is never placing the price in the bidding, is just specifying the quantity that he wants to buy. So a non-competitive bidder will not place a bid in terms of price at all. Non-competitive bidder is giving a clear indication that he or she is willing to buy that quantity irrespective of whatever price being offered. Now, the beauty of this whole process is a non-competitive bidder is actually placing a higher degree of faith in the sovereign debt issuance. That is why these investors are ready to buy these bonds at whatsoever price offered. Competitive bidder on the other side, they are playing trick. They are, asking for the best deal. So, who is placing more faith in the issuer? It is the bid placed by the non-competitive bidder. And that is why the advantage to them is when the issuance start happening, when the allocation starts happening, the first one in the queue will be the non-competitive bidder. So price will be discovered through the competitive bids. But at the best price, the bonds will be first offered to the non-competitive bidder. For example, if multiple competitive bidders have placed their bid, one asking for $990, another asking for $989, yet another one asking for $987, and of course these non-competitive bids will be kept aside. Competitive bids will be ranked. Whoever is paying the highest price will be ranked on top, correct? Because that is going to give a bigger receipt to the issuer. So among the competitive bidders, the best price will be the highest price, correct? And the highest price that is offered by any bidder, that bidder will be placed on top as the first rank or top priority. Then the allocation will be made in that order. At the end, whatever quantity left over will be issued to the last bidder in the queue, depending upon how many bids have been placed. For example, 990, 989, 988, 987 were the prices. So I am arranging these bids in that order, the top to bottom. Now, let's say the lowest price offered by any bidder was $980. But while the allocation happened, the allocation could not reach 980 at all. So the one placing the bid of 980, 981, 982, they never got any allocation at all. Say the allocation stopped when the price came to $985. That 985 will be considered as the cutoff price. Now what happens? Say out of 1 million such bonds to be issued, 400,000 bonds were demanded by non-competitive bidders. All those 400 bonds will be allocated to non-competitive bidders at the best price, that is $985 in that example. Now that's the beauty of non-competitive bid. Placing a non-competitive bid, you will be ranked on top in terms of allocation. Best price you are guaranteed to get. Whatever quantity you have demanded, you are guaranteed to get. In case of competitive bid, this sequence will be set in that order of ranking from top to bottom in terms of price, or someone can say from bottom to top in case of yield, because higher the price, the lesser is the yield. So whoever is demanding more yield is actually paying less price, because price and yield are inversely related, you know it very well. Now This whole process will be better understood when I take an example, a calculative example. So at CFA level 1, the examiner may not test you on the calculations involved over here, but the process in its entirety should be crystal clear to you. And let's move ahead in writing some important notes and followed by those examples. So in terms of notes ahead, you may write competitive bids. In a competitive bid, the investor specifies the quantity desired and the price they are willing to pay, or equivalently, the yield they are willing to accept. Competitive bids are crucial because they determine the auction's clearing price and yield. Competitive bidders help discover the market price for new government issue. They say, I want bonds, but only if I get them at this price or better. Let's move on to understand what are non-competitive bids. In a non-competitive bid, the investor specifies only the quantity desired but does not specify a price or yield. Non-competitive bidders are typically guaranteed the allocation subject to auctions rules or limits, and they receive securities at the price or yield determined by the competitive bidding outcome. So they accept the final auction price rather than negotiating it. What they say, I want bonds. I'll accept whatever final price is discovered in the auction. Now, what happens over here is the whole process of this auction and bidding, if you need to understand very well, you should understand the allocation process in two simple steps. If I talk about allocation, keep in mind one thing. Allocation will always begin with the non-competitive bidders. Price that they will be offered will be the auction price that is decided based on the competitive bids. So, understanding this process is crucial, and that is where I told you we will take a kind of numerical example to better understand the whole process. So, when the question arises how allocation happens in the auction, the first step is to allocate non-competitive bids first. That is, allocate to non-competitive bids. The issuer first satisfies all eligible non-competitive bids. These bidders receive securities at the final auction price or yield, the one discovered from the competitive bids. And once the issue has happened, or once the securities have been allocated to the non-competitive bidders, then comes the second step where you rank competitive bids and allocate the remaining supply. The remaining securities are allocated to competitive bids by ranking them in this order: highest price to lowest price, equivalently lowest yield to highest yield. So keep in mind one thing clearly: price and yield are inversely related. So you have been learning the bond valuation all your way. So in case you have yet to touch up the bond valuation aspect, I will simply tell you one thing. You specify the life of the bond, that is the tenor of the bond, or the remaining period to its maturity. You specify the annual coupon payment as the recurring payment. You specify the par value as the future value. Now, if you know the price, you can compute the yield. If you know the yield, you can compute the price. Correct? And higher the price, the lower will be the yield, and vice versa. As a result, when we are dealing with the sequencing or ranking the competitive bids, you should be very clear who stands in the first rank. Among various competitive bidders, The first rank will be for the bidder who has offered the highest price. So the one offering the highest price is actually accepting the lowest yield. So first maximum quantity will be allocated to that bidder. Then if there is any supply still left over, then and then only the allocation moves on to the next rank, who would have placed the bid of a little lower price and therefore accepting a little higher yield. So if you are ranking on the basis of price, it will go from highest to lowest. Just the other way is to view the ranking in the order of yield accepted. The yield will be ranked from lowest to highest. Never forget this. Many a times, if the question in exam is asking you the order of allocation in case of competitive bid in terms of yield will be one option lowest to highest, another option highest to lowest. Now what they have asked is yield, not the price. Had it been price, the ranking would have been done from highest to lowest. Because it is yield, it will be ranked in the order of lowest to highest. So these typical points will be tested in examination and you should be prepared for that. So let's move ahead in terms of our allocation process. So right ahead, this ranking makes sense because the issuer prefers to sell at highest price, which reduces the borrowing cost. Allocation continues down the rank list until the total offering amount is fully sold. Cutoff yield or stop out yield. The cutoff yield is the yield on the marginal accepted competitive bid, that is the last competitive bid that is needed to complete the sale. The auction accepts bids from lowest yield upward, since lowest yield equals to highest price. Therefore, cutoff yield is typically the highest yield among the accepted competitive bids. Now the other very important matter that is of high concern over here, the two types of auctions named as single price auction and multiple price auction. So as the name says, single price auction, all securities, whether to competitive bidders or to non-competitive bidders, will be issued at a single price. But on the other side, with respect to the multiple price auctions, the securities will be issued at different prices. So what happens in case of a multiple price auction? If you recollect the example that I gave you some time back, the competitive bids were ranked based on price, highest to lowest price. So 990, 989, 987, 986, 985 and so on. Say at 985, by the time you reached 985 in the order, all your allocations were completed. So all the bidders who have placed bids below 985 will not get anything at all. Those who have placed at the bid of 985 may or may not get the whole filling, means they would have demanded certain quantity, they may not get the entire quantity filled up, whatever they have ordered for or whatever they have asked for. They may get partial fill. Beyond that, anyone offering price lower than 985 would not have got any allocation at all. But at what price the securities were issued? So at 990 partial quantity, I mean out of the total quantity allocated, whoever has demanded at the price of 990, their demand was fulfilled, but out of the total lot, some quantity was given to 990 at the price of 990. Then some quantity at the price of 989, some quantity at the price of 988 and so on. That means issues are happening at multiple prices. That is multiple price auction. Now, what is the limitation or drawback of this multiple price auction? The drawback is that the securities are issued at different prices. That means right at the point of issuance, there is volatility in the price offered in the market. So, to avoid that volatility, the other choice is single price auction. But what happens in a single price auction? Because you have to maintain a single price, the cutoff price in that example that we have just discussed, that cutoff price was $9.85. Then each and every bidder will be offered the same static price, $9.85. So non-competitive bidders are anyway happy. Even competitive bidders who have placed a bid of say $990, even they are getting allocation at $985. That means the bid will be accepted at their price or a better price. Now, what is the disadvantage to the issuer under a single price auction? Because all issues were at that single price, but the lowest price, the yield offered will be definitely higher, and yield to the investor is basically the borrowing cost to the issuer. So the issuer's borrowing cost rises under a single price auction. On the other side, under a multiple price auction, the borrowing cost remains lower, because when the issues were made, they were at different prices. So the bond issue proceeds were collected partly at $990 per unit, partly at $989 per unit, and so on. Because the receipt was higher, the yield was lower, and hence the borrowing cost to the issuer is also lower. So single price auction and multiple price auction, they both have their own pros and cons. So generally government do not entertain volatility in the price at the time of issuance. So most of the government securities, these are issued at a single price auction. So in case of notes ahead, let me show you. Yeah, it is about single price versus multiple price auction formats. So single price auction, also known as uniform price auction, all successful bidders, that is competitive and non-competitive. Here successful bidders would mean the one who are getting the allocations fulfilled. They pay the same price. That common price corresponds to the cutoff price or cutoff yield at that stop out level. The stop out level or the cutoff level both resemble the same thing. Even if a few bidders bid more aggressively, they still pay the uniform stop out price. It can reduce the dispersion, very important line. It can reduce the dispersion of yields or price paid across the winning bidders, because everyone gets filled at a single or uniform auction clearing level. Now that is one thing. Let me just show this to you in case you want to take a screenshot or you want to pause the video and write it down. Now moving ahead, multiple price auction, pay as bid auction could be the other name for this. Each successful competitive bidder pays the price they actually bid. Hence, different winning bidders may pay different prices, obtain different yields for the same security. Because bidders in a pay as bid format pay what they bid, they may bid more cautiously, that is shade bids, compared with a uniform price format. Now this is something very important for you to understand, very important. See what happens in case of a single price auction. Say I am a competitive bidder, I know one thing for sure, that the yield will have a cutoff, or the price will have a cutoff somewhere at $985. But because I want to stay ahead in the rank, I am placing the bid of even $1,000. How does it matter? In that case, I will be by default placed on top. But because it is a single price auction, I'll be still getting the price of 985. So I may bid more aggressively in terms of price that I'm willing to offer so that I can stay on top. This happens in case of single price auction. However, under a multiple price auction, if I'm offering a price of $1,000, I'll have to pay $1,000 from my pocket, because pay as bid, whatever you are bidding, you end up paying that. That is the crux from the viewpoint of the investor. They have to be very, very cautious when it is a multiple price auction, but they can be, little aggressive. They can take chances when it is a single price auction. Now, as I told you that complete understanding can better be built when we take any calculative example, a numerical example, where some things will be very, very clear to all of you. So when I'm taking this calculative example, I believe that all of you watching this video are aware of how to make the use of TVM calculations, that is time value of money calculations, in your BA2 plus financial calculators. So with that assumption, I am showing the content ahead. If you do not know how to use your BA2 plus financial calculator, you should watch my other videos where I have explained to you the whole concept of the valuation and use of your financial calculators. So anyway, let's proceed with that example over here. So here comes that example. Let me read out this for you. This says 7% government bonds of rupees 1000, 10 years life were issued. Coupon is paid annually. Total issue size was 10 lakh units. Investors are required to place the bidding. Units demanded by non-competitive bidders were 4 lakh units. The details of bidding made by the competitive bidders are as below. Bidder A, B, C, D, E, F, and quantity bid, they have given the quantity and price 987, 986, 985, 983, 982 and 980. Now look at this. All these bidders, they have already been ranked, kind of, correct? The sequence is already set in terms of highest price to lowest price. When a question or an example conveys this kind of information to you, means it is already ranked. So you just have to do the later formality. So what the question is asking you: determine the following annual YTM corresponding to each bid price. Then you have to find the cutoff price, then the allocation quantity. Explain the outcome of multiple price versus single price auction. Now this example, if you can really understand the flow, you will get complete idea about the whole process, and this can enhance your understanding about the whole auction process. So we'll take things one by one. Let's begin with the allocation process first and identifying the cutoff price. Now what I am doing, I am going to just compute the allocation in terms of the remainder quantity after every issue. Initially we will not get into the discussion of multiple price versus single price. We'll first focus on the allocation process, because allocation process has nothing to do with what kind of auction it is, single price or multiple price. So allocation process remains the way it is or the way it should be, irrespective of the type of auction. That is why the type of auction and the pricing with respect to the price offered to each bidder under both single price and multiple price auction, we'll be talking about that at the end, because the question also has asked you that same thing at the end. However, if this question would have asked you this thing first, then also we will always begin with the allocation process. Now, the way I have explained to you everything earlier, who gets the allocation first? Without any doubts, don't get into this list at all. The first one to get their demand fulfilled will be these non-competitive bidders. They have demanded 4 lakh units. We don't know at what price we will be offering them these 4 lakh units, but definitely we will be offering 4 lakh units to them. Then comes the allocation to these competitive bidders. Now, what is the question asking you actually? The first thing, annual YTM corresponding to each bid price. So, looking at the basic data, it's a 10-year life bond and the par value is rupees 1000, coupon rate is 7%. So, annual coupon payment will be 7% of rupees 1000, that will be rupees 70, correct? The life of the bond being 10 years. So, when you are using your TVM calculation, N will be 10, payment will be, PMT will be 7% of 1000, that is 70, FV will be 1000, and if you give the input of this price 987 and compute I by Y, you know one thing, when you are giving the input of price, the input of price as the PV should be with the negative sign. Keep that caution, because FV is 1000 positive, coupon payment PMT is 70 positive, the P0 value or the PV value must be placed as a negative, and that will be 987 negative. So, when you give input of price, you can compute the I by Y thing, that is yield. So, yield you can determine, YTM of each bond you can determine. I mean the YTM corresponding to each price you can easily determine. So, let me show you how to do that. For bidder A. Now, this is not applicable for the non-competitive bidders. Why? Because they haven't bid any price at all. They have just demanded the quantity that they want. So, we are taking N equal to 10, PV as negative 987, PMT as 70, FV as 1000. Now, you apply CPT I by Y and you will be getting 7.19% as the yield. In the similar manner, you can make the computation for all other bidders. So, when you go to bidder B, correct, most of these will be common, right? N will remain 10, PMT will remain 70, FV will remain 1000. You just have to put the PV and you keep computing I by Y. So, now put the PV for bidder B, that comes to negative 986 as PV. So, CPT I by Y would result to 7.20%. Likewise, for bidder C, the price being 985, the yield comes to 7.22%. Are you noticing one thing? As and when the prices are reducing, the yields are rising. So, you compute the corresponding YTM for each price which is placed as a bid by competitive bidders, and I am sure you would have noted down these calculations. Now, let me take the opportunity to move ahead, and annual YTM corresponding to each bid price for each bidder A, B, C, D, E, F, that is competitive bidders, the quantity that they have bid, the price that they have bid, and now the corresponding yield that we have obtained. This is basically the summary of what we just concluded by far. So, notice one thing, as and when the prices are being offered lower and lower price, so the ranking has been arranged from highest price to lowest price, the yield goes from lowest to highest. So, yield is rising bidder after bidder, whereas the prices are falling. So, the ranking is already done. We are ready to move ahead for making the allocation. Allocation quantity and cutoff price in case of multiple price that is pay as bid auction. So non-competitive bidders will get 4 lakh units, whatever they demanded. We do not know the price at this stage. At this stage, definitely we do not know the price. Now let us move on to the competitive bidders. Competitive bidders, they would have demanded much more quantity, but the allocation what you have in your hand as the remainder quantity, that is only 10 lakh units minus 4 lakh units allocated to non-competitive bidders. For competitive bidders, what you can offer maximum is 6 lakh units. So now we go with each allocation one by one. So competitive bidder A has demanded 80,000. We have allocated 80,000. Now keep in mind one thing. You had the quantity in your hand as 6 lakh units. If you are allocating 80,000, the balance remains 5 lakh 20,000. The price at which you have offered this is rupees 987. Now the next bidder has demanded 2 lakh 40,000 units. You definitely have balance of 5 lakh 20,000 units in hand. You can definitely make the allocation entire 2 lakh 40,000 allocated. So now the balance quantity, that is 520 minus 240, it is 2 lakh 80,000 units left in your hand, and these 2 lakh 40,000 units were issued at 986 because we are dealing with this as a multiple price auction. Then bidder C has demanded 1 lakh 30,000 units. You certainly have that much, so you allocate entire 1 lakh 30,000 units and the balance quantity is 150. Bidder D has actually demanded more, but the allocation quantity will only be 1 lakh 50,000 because that was left, and the balance quantity left over after making the allocation to bidder D is nil, 0, and the price that you came as the last price is a 983. This 983 becomes the cutoff price. You can call it as cutoff price, and the corresponding yield to this price will be the stop out yield or cutoff yield. Now it is this price which, being a cutoff price, will be offered to whom? The non-competitive bidders, right? So let me show you that part as well, and I'm moving out of the view for your convenience. So 983 is the price which was offered to the non-competitive bidders, the best price in the entire auction. Bidder D gets partial fill, E and F don't get any because all quantity was exhausted at this stage itself. So make sure that you have either paused the video and you have done the writing work, or you would have taken screenshot of whatever is appearing on the screen right now, and that gives me an opportunity to move ahead. Now under multiple price, that is pay as bid auction, non-competitive bidders demanding 4 lakh units were issued the whole quantity 4 lakh units at a price of 983, and competitive bidders A, B, C and D were made the allocation at this price. Under single price auction, all these will be issued at one price, and you can say all successful bidders, competitive plus non-competitive, pay the same price, which is the cutoff price of rupees 983. So you can definitely pause the video and take note of this, and with that we will be putting an end to this discussion.